Before we begin, please note that the content in this video is for educational and informational purposes only and should not be construed as financial or investment advice. Trading foreign exchange on margin carries a high level of risk and may not be suitable for all individuals. Past performance is not indicative of future results. Please conduct your own thorough research and consult with a qualified professional before making any investment decisions. The information presented here is not a recommendation to buy or sell any currency. You're staring at a chart. The euro to US dollar may be the cable. It's 9:30 a.m. Eastern Time. The New York session is in full swing, and the lines on your screen are just wiggling. Moving up, moving down, a chaotic dance of green and red. Your heart is pounding because you have money on the line. You feel like you're just guessing, flipping a coin in the world's largest financial market. You place a trade, and a wave of anxiety washes over you as the market immediately seems to know exactly what you did, and does the opposite. If that sounds familiar, you are not alone. It's the single biggest reason why so many aspiring traders in the US give up. They see the charts as random noise, a financial Rorschach test with no right answer. But what if I told you it's not noise? What if it's a language? A language that tells a story of human emotion. A universal story of greed, fear, hope, and capitulation. And once you learn to read that language, the chaos starts to look like a conversation. The wiggles start to form words, sentences, and paragraphs. That is the power of chart patterns. They are the Rosetta Stone of the financial markets. And in this video, we are going to decode the 5 most powerful, most historically relevant chart patterns that every single US Forex trader needs to have burned into their brain. We're not just going to show you what they look like. We're going to dive deep into the psychology behind why they form, how to spot them in the heat of the New York session, and discuss common strategies traders use to navigate them. By the end of this, you won't just see lines on a screen. You'll see the battlefield, you'll understand the sentiment, and you'll be equipped with a framework to make more informed, less emotional trading decisions. So, why do these patterns even work? Is it some kind of financial voodoo? Absolutely not. It all comes down to one thing: human psychology, which is surprisingly predictable. For centuries across all markets, human beings have reacted to fear and greed in the same ways. When a price is rising, people feel euphoria and the fear of missing out, so they buy more, pushing it higher. When a price is falling, people feel panic and fear of further loss, so they sell, pushing it lower. These collective emotions, when drawn on a price chart over time, create repetitive, recognizable shapes. A chart pattern is simply a visual record of a psychological battle between buyers, who we call the bulls, and sellers, the bears. By learning to identify these patterns, you're essentially getting a sneak peek into the collective mind of the market. You're not predicting the future with a crystal ball. You're analyzing the present based on historical human behavior to assess probabilities. It's about shifting your mindset from a gambler to a strategist. And context is everything. A pattern on a 1-minute chart tells a very different story than the same pattern on a daily chart. The patterns we're talking about today are most potent when they appear on higher time frames, like the 1-hour, 4-hour, or daily charts, and especially when their completion coincides with high-volume trading periods, like the London-New York session overlap, which is prime time for US traders. That's when the big moves often happen. Alright, let's get into our first and arguably one of the most classic and reliable patterns in a trader's arsenal: the head and shoulders. This isn't just a pattern. It's a story of a trend dying. It's a top reversal pattern, meaning it often signals the potential end of an uptrend, or a bullish move, and the beginning of a new downtrend, a bearish move. Imagine a stock or a currency pair has been in a strong, healthy uptrend for days or weeks. Buyers are in complete control. First, you get the left shoulder. The bulls are confident. They push the price up to a new high. Everything looks great. Then, some profit-taking occurs. Early buyers cash out a little, causing a minor dip. This is completely normal in an uptrend. Then comes the head. The optimism is still sky-high. The dip is seen as a buying opportunity. A new wave of buyers, maybe those who missed the first run, jump in with force. They push the price not just back to the old high, but significantly past it, creating the highest point of the entire trend. This is the peak of euphoria. On the surface, the trend looks stronger than ever. But beneath the surface, something is changing. The smart money, the large institutions, might be starting to quietly distribute their positions, selling into this strength. The price then falls again, all the way back down to the level of the previous dip. Now, connect those two low points with a line. This line is the most critical part of the entire pattern. It's called the neckline. Think of it as the last line of defense for the buyers. It's the floor that's holding the uptrend together. Now for the final act, the right shoulder. The remaining bulls, the diehards, try to mount one last rally. They see the price at the neckline and think, great, another buying opportunity. They push the price up again, but this time it's weak. There's no conviction. The buying volume is often lower than it was during the creation of the head. They fail to make a new high. In fact, they can't even reach the height of the head. The rally fizzles out at a peak that's roughly symmetrical to the left shoulder. This failure is a massive red flag. It shows the world that the buying power is exhausted. The conviction is gone. The climax of this whole story is the break of the neckline. When the price falls from the right shoulder and slices through that neckline support with conviction, often on increased selling volume, it's the signal. It's the market screaming that the psychology has shifted. The bears have taken control of the battlefield. The uptrend is, for all intents and purposes, over, and a potential new downtrend is beginning. So how do traders approach this? This is purely for educational insight, not a set of instructions. A common method is to wait for a candle to close decisively below the neckline. Entering a short position right on the break is one approach. Another, more conservative approach, is to wait for a potential retest. This is when the price breaks the neckline, then pulls back up to kiss it from below, confirming it has now flipped from a support level into a new resistance level, before continuing its downward move. For managing the potential downside, traders often consider a stop-loss placement. A logical place could be just above the high of the right shoulder. If the price goes back up there, the pattern is invalidated. As for a potential target, a standard technique is to measure the vertical distance from the top of the head down to the neckline. Then, you project that same distance downward from the point where the price broke the neckline. This gives a calculated, hypothetical price objective for the move. Think about the pound sterling to US dollar on a 4-hour chart. It's been rallying for a week on positive UK economic news. You see the left shoulder form. Then during the New York session, some Fed news propels it to a massive new high, the head. But the rally stalls and it pulls all the way back. The bulls try again overnight, but the rally is feeble, forming the right shoulder. Then at 8:30 a.m. Eastern Time, a major US data release comes in stronger than expected for the dollar. Suddenly, sellers overwhelm the market. The neckline breaks. That entire story, that entire shift in sentiment, is painted right there on your chart as a perfect head and shoulders pattern, offering a potential roadmap for the sessions ahead. It's a powerful story-driven pattern, and it's number one on our list for a very good reason. Now let's move from the complex 3-act play of the head and shoulders to our number 2 pattern. A classic tale of a heavyweight title fight, the double top and the double bottom. If the head and shoulders is about a slow, deliberate transfer of power, the double top is a dramatic, brutal rejection at a key level. It's the market trying to punch through a ceiling once, getting knocked down, and then trying again with all its might, only to be knocked down for the count. Imagine a currency pair, let's say the Aussie dollar versus the US dollar, in a strong uptrend. Buyers are confident. The news is good. Price pushes up to a significant high, a level it hasn't seen in months. But at that peak it stalls. Sellers emerge, profit takers step in. The buying pressure evaporates and the price pulls back, forming a small valley. This is the first test. The market is catching its breath. But the bulls aren't done. They regroup, rally the troops, and launch a second assault on that same high. This is the critical moment. All eyes are on that previous peak. Will it break? Will the uptrend continue its glorious march higher? And then it fails. The price action hits that same level of resistance and is emphatically rejected. It fails to make a new high. This second peak, at or very near the level of the first, is a massive red flag. It's a signal that the buying power is exhausted. The people who bought near the top of that first peak are now nervous. The people who bought during the second rally are now trapped in losing positions. The failure to break higher tells the entire market that the sellers at that price level are stronger than the buyers. And when the price then breaks below the low of the valley between those two peaks, what we call the neckline or the support level, it's often the trigger for a cascade of selling. It's confirmation that the tide has turned. The psychology here is incredibly powerful. The double top is a story of failed ambition. It represents a clear line in the sand drawn by the sellers. The inverse of this, the double bottom, tells the opposite story. A story of resilience and a successful defense. Picture the US dollar falling against the Japanese yen. It hits a major support level, a floor where buyers have historically stepped in. The price bounces, forming a small rally, a peak of hope for the sellers. But then the selling pressure resumes and the price is driven back down to test that same floor. Again, this is the moment of truth. Will the support level hold, or will it shatter, leading to another leg down? When the price hits that support level a second time and holds, when buyers step in with force and prevent it from making a new low, it's a huge sign of strength. It tells you the sellers have thrown their best punch and couldn't break the defense. The short sellers who entered near that low are now sweating. As the price rallies and breaks above the peak between the two bottoms, it triggers a rush to cover short positions and attracts new buyers who were waiting for confirmation. This often leads to a sharp and sustained move higher. For U.S. traders, these patterns are everywhere, especially around key economic data releases from the Bureau of Labor Statistics or during Federal Reserve press conferences. Think about the lead-up to a major non-farm payrolls report. The market might rally into the number, hit a peak, sell off on uncertainty, and then try to retest that peak right after the number is released. If that retest fails, you have a classic double top on an intraday chart, signaling a potential reversal for the rest of the trading session. The key to trading these patterns isn't just recognizing the M shape of a double top or the W shape of a double bottom. It's about patience and confirmation. The pattern is not complete until the price breaks the neckline. Entering a trade simply because a second top or bottom appears to be forming is a classic novice mistake. You're trying to predict the future. Instead, successful traders often wait for the market to prove the pattern is valid. The break of that neckline is the market's confirmation. It's the starting gun for the new trend. Another layer of analysis is volume. In a textbook double top, you'll often see that the volume on the second peak is lighter than the volume on the first peak. What does this tell you? It suggests there's less conviction, less participation in that second attempt to move higher. The enthusiasm is waning. Conversely, in a double bottom, you might see volume pick up on the second low and then surge as the price breaks through the neckline. This indicates strong buying commitment and adds credibility to the potential for a reversal. And what about potential price objectives? A common technique used by analysts is to measure the height of the pattern, from the highest peak of the double top down to the neckline. They then project that same distance downward from the point where the neckline was broken. This gives a hypothetical area where the price might travel, a potential target based on the volatility of the pattern itself. It's not a guarantee, of course, but it provides a logical framework for assessing the potential risk and reward of a trade based on historical price behavior. Let's look at a real-world case study on the Euro to US dollar daily chart from a couple of years ago. The pair had been in a prolonged downtrend for months. It finally bottomed out, hitting a major psychological level just below parity. It bounced, rallied for a few weeks, and then sold off again, coming right back down to retest that exact same low. That was the first bottom. After the retest, where buyers showed up in force, the euro began a multi-month rally. This classic W formation, this double bottom on a major currency pair's daily chart, signaled a significant, long-term shift in sentiment. Traders who recognized the strength of that second test and waited for the confirmation break of the intermediate high were well positioned for the subsequent trend. It wasn't just a pattern, it was the market's way of telling a new story, the story that the dollar's dominance was for that period over. So, the double top and double bottom are about conflict at a boundary. They are less about a gradual power shift and more about a definitive test of a price level. When you see one forming, you're watching a battle of wills unfold in real time. But what happens when the market isn't reversing at all? What about when it's just taking a brief pause before continuing its original trajectory? That's where our third category of patterns comes in, the continuation patterns. These aren't stories of reversals, but stories of the market catching its breath. And the most classic of these, the one that signals a potential explosive continuation of a trend, is the flag pattern. It's a small, compact, and powerful formation that acts like a coiled spring, and we're breaking it down next. Let's picture that coiled spring. Imagine a powerful upward surge in the market. Let's say the US dollar to Japanese yen pair after a strong US jobs report. The price shoots up like a rocket. That initial explosive move is what we call the flagpole. It's a statement. It's the market showing its hand, revealing a sudden, powerful conviction in one direction. But no market can go straight up or straight down forever. It needs to breathe. It needs to consolidate. This is where the flag itself forms. Following that dramatic flagpole, the price action calples down into a small, compact, rectangular channel that gently slopes against the prevailing trend. So after a strong move up, the flag will be a neat little channel drifting slightly downwards. After a sharp drop, the flag will be a tight channel drifting slightly upwards. It looks quite literally like a flag hanging from a pole. The psychology here is fascinating. That initial flagpole move was driven by aggressive buyers or sellers. Now, during the flag formation, the market is in a temporary state of equilibrium. Some early movers are taking profits. Others are waiting on the sidelines, wondering if they missed the boat. The volume typically dries up during this period. It's quiet. It's the market holding its breath. But the key is that the price isn't reversing sharply. It's just drifting, digesting the recent move. This gentle pullback shows that the original force, the buyers in an uptrend or the sellers in a downtrend, are still largely in control. They're just reloading for the next push. The flag is the pause before the storm continues. We have two flavors of this pattern: the bull flag and the bear flag. A bull flag, as the name suggests, is a bullish continuation pattern. You get a strong flagpole moving up, followed by that downward sloping consolidation, the flag. This pattern suggests that despite the minor profit taking, the underlying strength is to the upside, and the trend is likely to resume. Conversely, the bear flag is its bearish twin. It starts with a sharp aggressive move down the flagpole. This could be triggered by negative economic data or a shift in central bank policy. Following this plunge, the price consolidates in a slightly upward sloping channel. This little rally is often seen as a dead cat bounce, or a weak attempt by buyers to fight the overwhelming selling pressure. It's a brief respite before the sellers are likely to regain control and push the price lower. Let's walk through a case study. Imagine it's a Tuesday morning, and the euro has been in a steady uptrend against the US dollar for a few weeks. Then, a key inflation report comes out of the eurozone, and it's much hotter than anyone expected. Traders immediately price in a more aggressive European central bank. In the span of just a couple of hours, the euro to US dollar shoots up 150 pips. It's a nearly vertical line on the chart. That's our flagpole. The volume is huge. The conviction is clear. But then it stalls. The price hits a psychological resistance level. Early buyers who are now sitting on a handsome profit decide to cash in. The price starts to drift down, but not aggressively. It forms a tidy downward sloping channel. Over the next day, it retraces about 30 pips of the big 150 pip move. Volume during this drift is noticeably lower than it was during the flagpole creation. This is our bull flag. It's a classic sign of a healthy trend. The market is absorbing the new information, shaking out weak hands and building up energy. Then, as the New York session opens on Wednesday, a major US bank releases a report confirming the bullish outlook for the euro. That's the catalyst. Volume suddenly surges. The price breaks decisively above the upper trend line of that flag channel. Traders who were waiting on the sidelines jump in, fearing they'll miss the next move. The profit takers from before, seeing the trend resume, might even buy back in. The result? The euro to US dollar embarks on another powerful leg up, often traveling a distance similar to the height of the original flagpole. So, how do you spot these in the wild and distinguish a real flag from a fake? First, the flagpole is non-negotiable. It must be a sharp, strong move. If the price just grinds its way up slowly, it's not a flagpole. We're looking for an explosion of momentum, typically accompanied by a spike in volume. Second, look at the flag itself. The consolidation should be orderly. It should be contained within two parallel trend lines, forming a channel or a rectangle. The volume should diminish significantly during this phase. If volume stays high or increases during the consolidation, it could be a warning sign that a battle is being fought, and a reversal might be more likely than a continuation. Also, the flag shouldn't be too long. A flag that drags on for too long can lose its predictive power. The initial momentum from the flagpole is dissipating. And critically, the flag shouldn't retrace too much of the flagpole. A common guideline is that the flag shouldn't pull back more than 50% of the flagpole's length. If it does, it starts to look less like a pause and more like a genuine reversal. The breakout is the moment of truth. This is the confirmation. For a bull flag, you're looking for a strong, decisive candle that closes above the upper trend line of the flag. For a bear flag, you're looking for a close below the lower trend line. And crucially, you want to see volume return on that breakout. A breakout on weak volume is suspect. It's like trying to launch a rocket with no fuel. It might sputter and fall back into the pattern. When it comes to trading strategies based on historical analysis of these patterns, traders have developed several common approaches. One popular entry method is to enter the trade once a candle closes outside the flag's trend line, confirming the breakout. A more aggressive approach might be to enter as soon as the price breaks the line, without waiting for the candle to close, though this carries a higher risk of being caught in a fake-out. A more conservative strategy involves waiting for the price to break out and then pull back to retest the broken trend line, using it as new support in a bull flag or new resistance in a bear flag before entering. For managing potential risk, a logical place for a stop-loss is typically just outside the other side of the flag. For a bull flag, the stop-loss would go just below the lowest low of the flag consolidation. For a bear flag, it would go just above the highest high. This way, if the pattern fails and the price reverses back through the consolidation, the potential loss is contained. As for potential profit targets, the classic textbook method is to measure the height of the flagpole from its base to the top of the pole. Then, you project that same distance from the point of the breakout. For example, if the flagpole was a 100 pip move, the projected target would be 100 pips above the breakout point. Of course, this is just a projection, a guidepost based on historical behavior. Other factors like major support and resistance levels should always be taken into account. The biggest mistake traders make with flags is impatience. They either see a strong move and a small pullback and immediately assume it's a flag without waiting for the pattern to fully form. Or they jump the gun on the breakout before it's confirmed with a candle close and a volume spike. Remember, the flag pattern is about the story of momentum, pause, and continuation. Every element, the strong pull, the weak flag, and the powerful breakout, needs to be there to complete the narrative. Without all the pieces, you might be reading the wrong story. The flag pattern is a perfect example of a market that's organized, trending, and simply taking a short break. It's a neat, tidy rectangle of consolidation. But what happens when that consolidation, that pause, doesn't form a neat little rectangle? What if the lines start squeezing together tighter and tighter like the tip of a spear? That's a different beast entirely, a pattern known as the wedge, and it can signal both continuation and explosive reversals. And that's what we're dissecting next. So let's talk about that spear tip. A wedge is a story of a battle where one side is slowly, methodically losing ground. Unlike a triangle where the market is coiling with uncertainty, a wedge shows a clear loss of momentum. It's the visual representation of exhaustion setting in. The key difference is that with a wedge, both the support and resistance lines are sloping in the same direction. Either both are pointing up or both are pointing down. It's this shared direction that tells the story. Let's start with the more common one you'll see, the rising wedge. Picture this. A currency pair is in an uptrend. Everything looks great. It's making higher highs and higher lows. But you start to notice something subtle. The new highs are getting progressively weaker. The price pushes up to a new peak, but it barely clears the last one. Then pulls back. Then it pushes up again, but with even less enthusiasm. Meanwhile, the lows are also rising, but they're rising faster than the highs. If you draw trend lines connecting these points, you get two ascending lines that are squeezing together, pointing upwards and to the right. This is the rising wedge, and in the context of an uptrend, it's often a powerful bearish reversal signal. It's telling you a story of bullish exhaustion. Think of it like a climber trying to scale a steep mountain. At first, he's taking big, powerful strides. But as he gets higher, the air gets thinner, his legs get heavier. His upward progress becomes smaller and smaller with each step. He's still moving up, but the energy is fading fast. That's precisely the psychology behind a rising wedge. The buyers are still in control, but their grip is weakening. They can't push the price up with the same force they once did. The smart money, the institutional traders, they see this. They see the waning momentum. They see the buyers getting tired. And they start preparing for a change in tide. The trigger, the classic signal that the party is over, is a decisive break and close below the lower support trend line. This is the moment the exhausted bulls finally give up the ghost. The floor gives way and sellers who were waiting on the sidelines rush in, often leading to a swift and sharp move downwards. Now, how do you add a layer of confirmation to this? Look at the volume. In a textbook rising wedge, you'll often see trading volume diminish as the pattern forms. As the price gets squeezed tighter and tighter, fewer and fewer people are participating. This declining volume confirms the story of fading momentum. It's like the crowd at a sports game getting quieter, because the action is becoming less exciting. But then, when that breakdown happens, when the price slices through that lower support line, you want to see a massive spike in volume. That's the roar of the crowd as the bears take the field. That surge in volume gives the breakdown credibility. It shows conviction. The rising wedge doesn't always have to be a reversal pattern, though. It can also act as a continuation pattern in a downtrend. Imagine a pair is falling hard. It then stages a weak rally, a bounce. This bounce takes the shape of a rising wedge. The price is technically moving up, but it's doing so with no power, no conviction. When it inevitably breaks down out of the bottom of that wedge, it signals that the brief rally is over, and the primary downtrend is ready to resume. It was just a pause, a bear market rally before the next leg down. Now let's flip the entire concept on its head and look at its bullish cousin, the falling wedge. This pattern typically forms after a prolonged downtrend and often signals a potential bullish reversal. The market has been beaten down. It's making lower lows and lower highs. Sentiment is terrible. But then, just like with the rising wedge, you notice a subtle change. The sellers are getting tired. Each new low they make is only slightly lower than the previous one. The downward momentum is drying up. The highs are also falling, but they're falling at a steeper rate than the lows. When you connect the points, you get two descending trend lines that are converging, pointing downwards and to the right. This is the falling wedge. The psychology here is one of bearish exhaustion. The sellers have been in complete control, pushing the price down relentlessly. But now they're running out of ammunition. They're trying to push the price to new lows, but they're meeting resistance. It's like trying to push a car that's running out of gas. You can still move it, but each push gets you less and less distance. The bulls who have been hiding out start to notice this. They see the selling pressure evaporate and sense an opportunity to take control at a low price. The signal for a potential reversal is a clean break and close above the upper resistance trend line. This is the moment the bears finally throw in the towel. Buyers who were waiting for a sign of strength rush into the market, and this can ignite a very powerful rally to the upside. And just like before, volume is your best friend for confirmation. As the falling wedge is forming, you'll typically see volume dry up, confirming the sellers are losing interest. But on that breakout above the upper trend line, you should see a significant increase in volume. This is the sign of conviction. It shows that buyers are entering the market with force, supporting the new upward direction. A great case study is to look at major market bottoms in pairs like Australian dollar to US dollar or NZD/USD after a long period of selling. You will often see these falling wedge patterns form right at the low. The breakout from that wedge, confirmed by volume, frequently marks the beginning of a new, sustained uptrend. And just like its counterpart, the falling wedge can also be a continuation pattern. In a strong uptrend, a currency pair might pull back or consolidate. This pullback can take the shape of a falling wedge. When the price breaks out to the upside from that wedge, it signals that the consolidation is over and the primary uptrend is likely to continue. It's a classic bull flag with a bit more nuance. So, when you see a wedge, what should you be thinking about? First, identify the direction. Is it rising or falling? A rising wedge suggests underlying weakness, while a falling wedge suggests underlying strength. Second, check the context. Is this forming after a long trend, suggesting a reversal? Or is it forming in the middle of a trend, suggesting a continuation? Third, and this is critical, be patient and wait for the break. The biggest trap with wedges is the false breakout. The price might poke its nose outside the trend line for a few minutes only to get sucked right back in. Many traders wait for a full candle, like a 4-hour or daily candle, to close outside the pattern to confirm the break is real. And finally, consider the target. A common method used to estimate a potential target after a breakout is to measure the height of the wedge at its widest point, the base, and then project that distance from the point of the breakout. So, if the base of a falling wedge is 200 pips wide, you might look for a potential move of 200 pips up from where the price broke out of the upper trend line. This isn't a guarantee, but it provides a logical framework and a potential area to monitor price action. The wedge pattern is so powerful because it tells a deep story about the psychology of the market. It's not just lines on a chart. It's a visual depiction of a struggle where one side is becoming exhausted. Recognizing this exhaustion before the rest of the market does can provide a significant edge. It's about seeing the subtle shift in the balance of power between buyers and sellers just before the scales tip dramatically. So we've seen triangles which show indecision and wedges which show exhaustion. But what happens when the market isn't indecisive or tired, but is instead building a base, a solid foundation of support or a ceiling of resistance, testing it over and over again? This creates one of the most reliable and visually obvious patterns in all of trading, the double top and double bottom. And that's where we're headed next. So what happens when an uptrend, a powerful charging bull market, slams into a brick wall? Not just once but twice? This is the story of the double top. A pattern so classic it's often called the M pattern for its distinct shape on the chart. It's a tale of exhaustion, of a failed second chance. And it's one of the most powerful signals that a trend reversal could be on the horizon. Imagine a currency pair. Let's say the US dollar versus the Japanese yen has been on a tear. Buyers are euphoric, pushing prices higher and higher. They reach a peak, a new high, let's call it 150 yen. At this point, some sellers start to think, this is getting overvalued. They begin to sell, and the price pulls back, finding some temporary footing at a lower level, say 148.50. This pullback area is critical, we call it the neckline. It's the line in the sand. Now the original buyers, the bulls, see this dip as a buying opportunity. They think the uptrend is still intact, so they pile back in, attempting to drive the price to new highs. They push, and the price rallies right back up towards that 150 yen level. And this is the moment of truth. This is where the entire story is decided. If they can break through that previous high with conviction, the uptrend continues. But with a double top, they fail. They hit that same ceiling of resistance and are rejected. This failure is a massive psychological blow. The buyers who bought on the dip are now at a loss. The sellers who sold at the first peak are proven right. And every trader watching sees that the buying momentum has vanished. The inability to make a new high is a huge red flag. This second peak, failing at or near the level of the first, signals that the sellers have absorbed all the buying pressure. They're now in control. The pattern is officially confirmed not when the second peak forms, but when the price crashes back down and breaks below that neckline at 148.50. That break is the starting gun for a potential new downtrend, often triggering a cascade of sell orders as the last of the hopeful buyers finally capitulate and sell their positions to cut their losses. A key detail many experienced traders watch for is volume. Typically, the volume is strong on the first peak, but on the second peak, the volume is often lower. This suggests a lack of conviction from the buyers on their second attempt. Then when the price breaks the neckline, you'll often see a surge in volume, confirming the seller's dominance. Now let's flip this entire concept on its head to understand its bullish counterpart, the double bottom, or the W pattern. This is a story of hope emerging from despair. Imagine a currency pair, maybe the British pound against the US dollar, has been in a brutal downtrend. Sellers are in complete control, pushing the price to a significant low, let's say 1.2000. At this level, some buyers start to see value. They think, this has been oversold. They begin to buy, causing a relief rally, a bounce up to a resistance level, maybe 1.2150. This is our neckline. The sellers, seeing this bounce, think it's their chance to get in on the downtrend at a better price. They re-engage, pushing the price back down, aiming to break that previous low of 1.2000 and continue the free fall. But just like before, this is the moment of truth. The price reaches that 1.2000 level, and it holds. The sellers cannot push it any lower. This failure to make a new low is the first sign that the sellers are running out of steam. The downward momentum is fading. Buyers see this as a critical opportunity. They defended the low once, and now they've defended it again. This creates a foundation, a solid floor of support. The double bottom pattern is confirmed when the buyer sees control and push the price not just away from the low, but decisively up and through that neckline at 1.2150. That breakout signals that the downtrend is likely over, and a new potential uptrend is beginning. And just like with the double top, volume can tell a deeper story. Volume is often high on the first bottom as sellers panic, but on the second bottom it tends to be lighter, showing the selling pressure is easing. Then, on the breakout above the neckline, volume should ideally increase as conviction from the buyers floods into the market. So, how do traders approach these powerful reversal signals? The first and most important rule is patience. The pattern is not complete until the neckline is broken. Trying to buy at the second bottom or sell at the second top before the confirmation is an aggressive, high-risk play because the trend could simply resume. The breakout is the confirmation that the psychology of the market has shifted. Once that breakout occurs, many traders look at the height of the pattern itself to project a potential price target. For example, if our double top on US dollar to Japanese yen had its peaks at 150 and a neckline at 148.50, the height of the pattern is 150 pips. A common technique is to measure that 150 pips from the point of the neckline break, which would give a potential target around 147.00. It's not a guarantee, but a framework based on the energy contained within the pattern. Think of the pattern as a coiled spring. Its height gives you an idea of how far the price might travel once the energy is released. The same logic applies to the double bottom. If the W pattern on the pound was 150 pips from the lows to the neckline, a breakout above the neckline could lead traders to look for a potential move of another 150 pips upwards. This measured move concept provides a logical way to set targets and assess the risk-to-reward potential of a trade. Finally, context is everything. A double top or bottom on a 15-minute chart is interesting, but on a daily or weekly chart, it's a major event that gets the attention of institutional traders around the world. These patterns carry far more weight when they form at historically significant price levels, a multi-year high, a major support zone from the past, or a big round number that everyone is watching. When you see a perfect M or W forming at one of these critical junctures, you are witnessing a major battle between buyers and sellers, and the outcome can dictate the market's direction for weeks or even months to come. These patterns tell a clear story of a trend hitting a wall, trying again and failing, leading to a dramatic reversal. But what if the market isn't reversing? What if it's just taking a breath, pausing to gather strength before continuing its original explosive move? That's an entirely different story, told by patterns that look less like a brick wall and more like a tightly wound coil of energy. These are the continuation patterns, and they signal that the big move is likely not over yet. And one of the most classic forms this takes is the flag and the pennant. That's where we're going next. The flag and the pennant are the quintessential pause patterns. Think of them like this: you've just witnessed a sprinter explode out of the blocks for the first 50 meters of a 100-meter dash. It's an incredible burst of power and speed. But then, for just a split second, they seem to collect themselves, realign their form, take a single deep breath before reigniting for the final 50 meters. That brief moment of collection isn't a sign of weakness. It's a sign of a professional preparing for the second, and often equally powerful, phase of the move. In the markets, that's exactly what flags and pennants represent. They are the market catching its breath. Let's break down the anatomy, starting with the bull and bear flag. Every flag pattern has two essential components: the flagpole and the flag itself. The flagpole is the explosive move that starts it all. This is not a gentle, meandering trend. This is a sharp, almost vertical price movement on significant volume. It's the market making a statement. It could be triggered by a major economic data release, a central bank announcement, or a sudden massive influx of orders. Without a clear, strong flagpole, you do not have a flag pattern. It's the single most important prerequisite. After this initial burst of energy, the market enters a consolidation phase. This is the flag. It looks like a small rectangular channel that slopes against the prevailing trend. This is a crucial detail. For a bull flag, where the flagpole is a powerful move up, the flag itself will be a neat, downward sloping channel. For a bear flag, where the flagpole is a sharp drop, the flag will be an upward sloping channel. Why does it slope against the trend? This is where the psychology comes in. Let's take the bull flag. The initial spike upwards, the flagpole, creates a lot of instant profit for traders who got in early. During the consolidation phase, the flag, some of these traders start taking profits. This selling pressure causes the price to drift downward slightly. At the same time, traders who missed the initial move are watching, waiting for a chance to get in, but they're hesitant. They're afraid they missed the boat. This creates a temporary equilibrium. The profit-taking isn't strong enough to reverse the trend, but the new buying isn't strong enough yet to push prices higher. The result is this gentle, orderly pullback within a channel. It's a period of digestion. The market is shaking out the weak hands and allowing new, stronger buyers to accumulate positions at a slightly better price before the anticipated next leg up. The decreasing volume during the flag formation is your evidence. It shows that the selling is not aggressive. It's passive profit-taking, not a fundamental shift in sentiment. Now let's look at its close cousin, the pennant. The pennant shares the exact same first component, a strong, dramatic flagpole. The initial move is identical. The difference lies in the consolidation phase. Instead of forming a rectangular channel, the price action in a pennant converges. The highs get lower, and the lows get higher, forming a small symmetrical triangle, the pennant. It looks like a tiny flag being squeezed from both sides. The psychology here is similar to the flag, but with a slight twist. The converging trend lines of the pennant represent an even tighter coiling of energy. The indecision is more acute. Neither buyers nor sellers can gain the upper hand, and the price range gets narrower and narrower. Volume typically dries up even more dramatically than in a flag pattern. It's like pressure building inside a sealed container. Everyone is waiting for the next big move. And as the price approaches the apex of the triangle, a breakout becomes almost inevitable. The market simply can't stay in that tight of a range forever. This coiling action is what gives the pennant its reputation for often preceding an exceptionally fast and powerful continuation move. So, how do traders typically approach identifying and analyzing these patterns? The process is methodical. First, and always first, is to identify the flagpole. Scan your charts for a currency pair that has just made a near vertical move on heavy volume. This is your initial signal. Without it, anything else is just a channel or a triangle, not a continuation pattern. Second, watch the price action immediately following the flagpole. Does it start to consolidate in an orderly fashion? If you can draw two parallel, sloping trend lines that contain the price action, you may be looking at a flag. If the trend lines are converging into a point, you might have a pennant. Remember the slope. A bull flag should slope down and a bear flag should slope up. Third, keep a close eye on the volume. This is your confirmation tool. Volume should be exceptionally high during the flagpole, then it should noticeably decrease and dry up during the formation of the flag or pennant. This confirms the resting phase theory. A lack of volume during consolidation suggests a lack of conviction from the counter-trend side. The final piece of the puzzle is the breakout. The pattern is considered confirmed for many traders when the price breaks out of the consolidation area in the direction of the original flagpole. For a bull flag or pennant, that means a decisive close above the upper trend line. For a bear flag or pennant, it's a decisive close below the lower trend line. A surge in volume accompanying this breakout is a very strong sign that the period of consolidation is over and the original trend is resuming with force. Now let's talk about potential objectives and risk management, which are critical components of any trading plan. One of the most common techniques used to estimate a potential price target for these patterns is the measured move. The logic is straightforward. Traders measure the height of the flagpole from its base to its peak. Then they project that same distance from the point of the breakout. For example, if the flagpole on a US dollar to Japanese yen bull flag was a 200 pip move, the theoretical price target would be 200 pips above the point where the price broke out from the top of the flag. This provides a logical area to watch, though it's a guide, not a certainty. Equally important is managing risk. No pattern works 100% of the time. A failed pattern is always a possibility. A common approach to risk management is to place a stop-loss order just outside the consolidation pattern, on the opposite side of the breakout. For a bull flag, this would mean placing a stop-loss just below the lower trend line of the flag. If the price breaks out to the upside but then fails and falls back below that lower trend line, the trade idea is invalidated, and the position is closed for a manageable loss. This prevents a small loss from turning into a catastrophic one if the pattern fails and a full-blown reversal occurs. Let's walk through a hypothetical case study on the pound sterling to US dollar 1-hour chart. Imagine the Bank of England releases an unexpectedly positive inflation report at 8 a.m. Eastern Time. In response, the pound surges against the dollar, and the pound sterling to US dollar pair rockets up 180 pips in just 2 hours. The volume bars on your chart are the biggest they've been all week. This is our flagpole. Over the next 10 hours, the market calms down. The price starts to drift gently downwards in a very well-defined channel. It gives back about 40 pips of the initial move, but the selling is light, and the volume is fading with each passing hour. You draw two parallel trend lines and it's a perfect textbook bull flag. Then, during the London-New York session overlap, you see a long green candle form. It closes decisively above the upper trend line of the flag. At the same time, the volume indicator spikes, showing a sudden rush of buying interest. This is the breakout signal. Using the measured move technique, you would take the height of the initial flagpole, 180 pips, and add it to the breakout price. This gives you a potential price objective for the trade. To manage risk, a stop-loss could be placed just below the lowest low made inside the flag channel. This way, if the breakout turns out to be false, the potential loss is contained. It's important to remember a few nuances. These patterns are typically short-term. They are about immediate trend continuation, usually playing out over several hours to several days, maybe a couple of weeks at most on a daily chart. They are not long-term investment signals. Furthermore, a flag that is perfectly horizontal or, even worse, slopes with the trend is a warning sign. A bull flag that slopes up is often a rising wedge, which can be a reversal signal, not a continuation one. The counter-trend slope is key. Flags and pennants are powerful because they provide a complete picture. They show the initial burst of institutional momentum, a period of healthy consolidation and profit-taking, and a potential entry point for the next wave of that momentum. They tell a clear story of a trend that is not exhausted, but merely reloading. They are the market's version of a coiled spring, and when that spring is released, the move can be fast and decisive. These patterns help us see when the smart money is likely taking a brief pause rather than heading for the exits entirely. But what happens when the pause gets longer, when the indecision deepens, and the battle between buyers and sellers becomes a more drawn-out war of attrition? That's when we start to see the formation of triangles, which can be even more complex and tell a different kind of story. And that's exactly what we'll dissect next. So when the market takes a breather, but the battle between buyers and sellers becomes a more drawn-out war of attrition, that's when we start to see the formation of triangles, which can be even more complex and tell a different kind of story. And that's exactly what we'll dissect next. Unlike the short, explosive consolidation of flags and pennants, triangles are the market's slow burn. Think of it like a coiled spring. The price action gets tighter and tighter, compressing into a smaller and smaller space, building up an incredible amount of potential energy. Everyone in the market knows something big is about to happen. The tension is palpable. The only question is, which way will it snap when it finally breaks? Triangles are defined by two converging trend lines, and they come in three main flavors, each telling a slightly different story about the underlying psychology of the market. Let's start with the most neutral of the three, the symmetrical triangle. Imagine a chart where the price is making a series of lower highs and higher lows. If you draw a trend line connecting the peaks, it will be sloping downwards. If you draw another trend line connecting the troughs, it will be sloping upwards. These two lines are converging towards each other, creating a shape that looks like a sideways triangle. This is the symmetrical triangle, and it represents pure, unadulterated market indecision. Neither the buyers nor the sellers can gain the upper hand. Every time the buyers push the price up, the sellers step in a little earlier than before. And every time the sellers push the price down, the buyers step in a little sooner. The range is tightening. The walls are closing in. This pattern tells you that the market is coiling for a significant move, but it doesn't give you a strong bias in either direction. It's considered a continuation pattern, meaning it often breaks out in the direction of the preceding trend, but it's less reliable in that regard than, say, a flag pattern. The real story here is the impending volatility. So how might a trader approach this? The key is patience. Entering a trade while the price is still bouncing around inside the triangle is like flipping a coin in a hurricane. The prudent approach is to wait for the breakout. You're waiting for the price to decisively close above the upper trend line or below the lower trend line. A classic case study might involve the euro to US dollar pair during a period of conflicting economic data from both the Eurozone and the United States. You might see it form a beautiful symmetrical triangle over several weeks. A trader would mark the two trend lines and set alerts. If the price breaks and closes convincingly above the upper resistance line, it could signal that the buyers have finally won the war, suggesting a potential long position. Conversely, a break and close below the lower support line could indicate the sellers have taken control, presenting a potential shorting opportunity. The direction of the break is your signal. Now let's look at a triangle that has a bit more of a directional bias. The ascending triangle. This is a distinctly bullish pattern. Here's how it forms. You have a flat horizontal line of resistance at the top. The price hits this level and gets rejected time and time again. But here's the crucial part. The lows are getting progressively higher. If you draw a trend line connecting these rising lows, you get an ascending line that converges with the flat resistance line. What story is this pattern telling? It's a story of determined buyers. There's a clear ceiling where sellers are active, holding the line. But with each pullback, the buyers are getting more aggressive. They're not waiting for the price to drop as low as it did before. They're stepping in sooner at higher and higher prices. This action creates the rising support line. It shows that the buying pressure is systematically building, chipping away at that overhead resistance. It's like waves relentlessly crashing against a cliff. Eventually, the cliff is likely to give way. An ascending triangle often forms during an uptrend and acts as a continuation pattern. For example, imagine the Australian dollar to US dollar is in a strong uptrend because of rising iron ore prices. It hits a major resistance level, say 0.7500, and stalls. For the next month it pulls back, but the first low is at 0.7350, the next is at 0.7400, and the next is at 0.7425. You have a flat ceiling at 0.7500 and a rising floor of support. This is a classic ascending triangle. The expectation here is for an eventual breakout to the upside. Traders watching this pattern would be looking for a strong, high volume candle to close above that 0.7500 resistance level. That breakout would be the signal that the sellers at that level have been exhausted, and the original uptrend is likely to resume. Of course, if there's an ascending triangle, there has to be its bearish twin, the descending triangle. As you can probably guess, it's the exact opposite. This pattern is defined by a flat, horizontal support level at the bottom and a series of progressively lower highs. The price keeps falling to a specific support level where buyers step in, but on each bounce, the sellers get more aggressive, pushing the price down from a lower point than before. This creates a descending trend line that converges with the flat support line. The psychology here is one of increasing selling pressure. There's a floor of support where buyers are making a stand, but their bounces are getting weaker and weaker. The sellers are gaining control, and the market is signaling that the support level is under serious threat. It's like a boxer being pushed into the corner of the ring. The support is there, but the pressure is relentless, and a breakdown seems increasingly probable. Descending triangles are typically considered bearish continuation patterns that form during a downtrend. Let's take the US dollar to Japanese yen during a risk-off period in the global markets, where investors are seeking the perceived safety of the Japanese yen. The pair might be in a downtrend and find temporary support at 110.00. It bounces but only to 111.00 before sellers push it back down. The next bounce only reaches 110.75. The one after that only gets to 110.50. You have a solid floor at 110.00, but a clear descending line of resistance is forming. This descending triangle is a warning sign. It suggests the selling pressure is building, and that the 110.00 support level is in danger of breaking. A trader would watch for a decisive, high-volume candle to close below that 110.00 level. Such a break would signal that the buyers have capitulated, and the downtrend is likely to continue. Now, regardless of which triangle you're looking at, there are a few universal rules that can dramatically improve your analysis. First, pay close attention to volume. In a textbook triangle formation, volume should diminish as the pattern develops. This reflects the decrease in activity and the growing indecision as the price range tightens. Then, on the breakout, you want to see a significant spike in volume. This is your confirmation. It's the market shouting that the period of consolidation is over and a new directional move has begun with conviction. A breakout on low volume is a major red flag. It's much more likely to be a false move, a fake-out, designed to trap traders on the wrong side. Second, always wait for confirmation of the breakout. Don't try to anticipate it. A common mistake is to buy at the bottom of an ascending triangle or short at the top of a descending one, assuming the pattern will play out. This is a low probability approach. Wait for the price to actually break and ideally close outside the trend line. An even more conservative strategy is to wait for a break and retest. This is where the price breaks out of the triangle and then pulls back to test the old trend line as a new level of support or resistance. If it holds, it provides a powerful secondary confirmation that the breakout is legitimate. Finally, triangles can offer a way to project potential price targets. A common method is to measure the height of the triangle at its widest part, the base, and then project that distance from the breakout point. So, if the base of an ascending triangle is 200 pips wide and it breaks out to the upside, a hypothetical target could be 200 pips above the breakout point. This isn't a guarantee, but it provides a logical framework for setting profit targets and evaluating the risk-to-reward ratio of a potential trade. These consolidation patterns, flags, pennants, and triangles, are all about the market taking a pause, building energy before continuing a trend. But what happens when the pressure doesn't just continue the old trend, but completely shatters it and sends the market screaming in the opposite direction? That's when we enter the realm of powerful reversal patterns, and the story they tell is one of a dramatic shift in market power. Our first major reversal pattern is one of the most classic and widely recognized formations in all of technical analysis, the head and shoulders. And the story it tells is a masterpiece of market psychology, a three-act play of a bull market's final dramatic downfall. Imagine a powerful uptrend. The buyers are in complete control, pushing the price higher and higher. This is Act 1, the left shoulder. The market rallies to a new peak, confidence is high, but then, as is natural, it pulls back a bit to catch its breath. Profit takers step in and a small trough is formed, but the herd is still bullish. They see this dip as a buying opportunity, and they pile back in, driving the price with even greater force to a new higher peak. This is Act 2, the head. This is the climax of the uptrend, the highest point the market will reach. On the surface, it looks like the ultimate confirmation of strength. But a savvy trader might notice something subtle. Often, the volume on this new, higher peak is actually lower than the volume on the left shoulder. It's a quiet warning. It's like a cheer from a crowd that's a little less enthusiastic than before. The conviction is starting to wane. Following this climactic peak, the price falls again, typically back down to a level similar to the previous low, the trough after the left shoulder. This is where the real drama begins. The bulls, conditioned to buy every dip, try one more time to rally. They push the price up again, but this time they run out of steam. They fail to reach the height of the head. This new lower peak is Act 3, the right shoulder. This failure is a massive red flag. It's a clear signal that the buying power that defined the trend is exhausted. The bulls gave it one last shot, and they just didn't have the strength. Now connect the two troughs, the low after the left shoulder and the low after the head. This line is the most important part of the entire pattern. It's called the neckline. This isn't just a line on a chart. It's the line in the sand. It's the last line of defense for the bulls. As long as the price stays above the neckline, there's still a glimmer of hope for the uptrend. But if the price breaks below that neckline, the play is over. The dam has broken. It's the ultimate confirmation that the sellers have seized control of the market. The shift in power is complete. For traders observing this pattern, the break of the neckline is the critical event. A common approach involves waiting for a decisive candle to close below this level as confirmation. Some traders might look for an entry on this breakdown, while others, perhaps more conservative, wait for a potential retest. This is when the price breaks down, then pulls back up to kiss the neckline from below, confirming it as new resistance before heading lower. As for managing risk, a popular technique is to place a stop-loss order above the high of the right shoulder. The logic here is that if the price rallies back above that point, the bearish narrative of the pattern has been invalidated. And what about the potential extent of the move? A widely used method for estimating a price target is to measure the vertical distance from the top of the head down to the neckline. Then, you project that same distance downwards from the point where the price broke the neckline. This provides a calculated area where the price might head, based on the volatility of the pattern itself. Of course, this entire story can be told in reverse. At the bottom of a long, painful downtrend, we can see the formation of an inverse head and shoulders, also known as a head and shoulders bottom. It's the same three-act play, but this time it's a story of bullish resurrection. You have the bears pushing the price down to a new low, the left shoulder, a brief rally, and then a final desperate push by the sellers to an even lower low, the head, often on weaker volume, signaling their exhaustion. Then a stronger rally is followed by a higher low, the right shoulder, showing the sellers can no longer push the price down to its previous depths. The neckline connects the two peaks in the pattern. A break above this neckline signals that the buyers have finally wrestled control from the exhausted bears, and a new uptrend could be starting. The psychology is a perfect mirror image, a story of failure, but this time it's the sellers who are failing. Now let's move to another titan of reversal patterns, one that tells a simpler, but no less powerful story of exhaustion, the double top. Think of this pattern as a market hitting a brick wall. Twice, an asset is in a strong uptrend, making higher highs and higher lows. It rallies up to a significant price level and then pulls back. This peak is the first top. At this point, everything still looks fine. It's just a normal pullback in an uptrend. The buyers regroup and, believing the trend will continue, they launch another assault, driving the price right back up to the level of the previous peak. But it stops there. It hits that same ceiling and is rejected again. This is the second top. The failure to create a new high is a huge warning sign. It's the market screaming that there is significant selling pressure at this level. A wall of sellers that the buyers simply cannot break through. The psychology is critical here. The first peak could be anything, but the second peak, at or very near the same price as the first, is a deliberate statement. It shows that the forces that stopped the rally the first time are still there, and they are just as strong. Buyer enthusiasm evaporates. Those who bought near the top are now nervous, and those who were waiting to sell see their chance. The confirmation for the double top pattern comes from the low point reached between the two peaks. This trough creates a support level, or a confirmation line. A decisive break below this line is the signal that the sellers have not only defended their territory at the top, but are now on the offensive, pushing the price down. It's the trigger that suggests the uptrend is over, and a downtrend is beginning. Traders watching this pattern often look for that break of the support line as a potential entry point. A common risk management strategy involves placing a stop-loss just above the highs of the two peaks. If the price were to break through that ceiling, the entire bearish premise of the pattern would be nullified. To project a potential price target, a standard technique is to measure the height of the pattern, from the peaks down to the support line, and then project that distance downwards from the breakout point. It's a logical way to estimate how far the price might fall based on the pattern's own volatility. And just like the head and shoulders, this pattern has a bullish twin, the double bottom. You can probably guess the story this one tells. After a prolonged downtrend, the price hits a low, bounces, sells off again, but finds support at or near the exact same low point. Visually, it forms a distinct W shape on the chart. This is the story of sellers trying to push the market lower, but they fail. They try again, and they fail again at the same level. This is a powerful sign that the selling pressure is drying up and a strong base of buyers is stepping in at that price. The line to watch is the resistance level formed by the peak of the bounce between the two bottoms. A break above this confirmation line signals that the buyers have absorbed all the selling pressure and are now in control, potentially kicking off a new uptrend. The trading logic is the inverse of the double top. A potential entry is on the break of the resistance line. A stop-loss could be placed below the two lows, and the price target is often projected by taking the height of the W and adding it to the breakout point. These reversal patterns, the head and shoulders and the double tops and bottoms, are so foundational because they paint such a clear picture of a struggle for control. They show us the exact moment when a dominant force grows tired and a new power takes over. They are the turning points in the market story. But what about a pattern that signals a reversal with the explosive force of a coiled spring being released? That brings us to our final and perhaps most dynamic chart pattern, the wedge. This pattern is the ultimate story of a fight to the bitter end, a battle of attrition where one side doesn't just lose, they collapse from sheer exhaustion. It's the market taking a deep breath, coiling all its energy into a tightening consolidation before it explodes in the opposite direction. Unlike the broad, swinging battles of a head and shoulders or a double top, the wedge is a claustrophobic fight in a narrowing hallway. And when the wall breaks, the force is immense. Let's start with its bullish form, the falling wedge. Imagine a currency pair, let's say the euro versus the US dollar, has been in a downtrend. Sellers are in complete control. Every rally is sold off, and the price keeps making lower lows and lower highs. It looks bleak, but then something subtle starts to change. The sellers are still pushing the price down to new lows, but they're not getting as far as they used to. The downward thrusts are becoming weaker, shallower. At the same time, the buyers who were once completely overwhelmed are starting to show a bit of courage. They're stepping in a little bit earlier each time. They're not strong enough to create a higher high yet, but they're preventing the price from falling as fast. If you were to draw lines on this chart, you'd connect the series of lower highs with a downward sloping trend line. And you'd connect the series of lower lows with another downward sloping trend line. But here's the critical detail. The lower line, the support line, is steeper than the upper resistance line. This creates a cone, or a wedge, pointing downwards. This visual tells the entire story. It shows that the selling pressure is waning. The downward momentum is fading. Think of it like a boxer in the final round of a championship fight. He's still throwing punches, still technically on the offensive, but each jab has less power. He's exhausted. His opponent, the buyers, has been taking the hits, weathering the storm, and can sense the weakness. They're waiting for that one moment of fatigue to launch a devastating counterattack. The falling wedge is that moment of fatigue captured on a chart. So, how do traders analyze this pattern? First, identification. You need to see the price action becoming compressed between two converging, downward sloping trend lines. Ideally, you want to see at least 2, preferably 3 touches on each line to validate the pattern. The more touches, the more significant the coming battle. The second and most crucial element is the breakout. The pattern is not confirmed until the price decisively breaks and closes above the upper resistance trend line. This is the signal. This is the counterpunch. It's the market screaming that the sellers have finally collapsed and the buyers have seized control. Many traders look for a confirmation of this breakout through volume. A significant spike in trading volume as the price breaks out of the wedge is a powerful sign. It's like a crowd roaring its approval, confirming that a wave of new buying pressure is entering the market. Without that volume, a breakout can sometimes be a fake-out, a head fake before the price falls back inside the pattern. Once a breakout is confirmed, the question becomes, where could the price potentially go? A classic technical analysis technique is to measure the height of the wedge at its widest point, the beginning of the pattern, and then project that distance upward from the point of the breakout. This provides a hypothetical target, a potential destination for the move. It's a way of estimating the power that was coiled up inside that wedge. Of course, this is a theoretical projection based on historical pattern behavior, not a certainty. For risk management, a common approach is to place a stop-loss order below the most recent swing low inside the wedge. This defines the risk on the trade. It's the predefined point where the analysis would be considered invalidated. Now let's flip the script and look at the sinister twin of the falling wedge, the rising wedge. This is a bearish reversal pattern, and it tells a story of hollow victory and impending collapse. Picture the opposite scenario. A currency pair is in a strong uptrend. The mood is euphoric. Everyone is buying, and every small dip is seen as a golden opportunity. The price is consistently making higher highs and higher lows. But just like before, a subtle sickness begins to creep into the trend. The buyers are still managing to push the price to new highs, but each new high is only marginally above the last one. The rallies are becoming shorter, more labored. The upward momentum is clearly fading. Meanwhile, the sellers are getting a bit more aggressive. The pullbacks are starting to get a little deeper. Visually, this forms a wedge pointing upwards. You have two converging trend lines, but this time the lower support line is steeper than the upper resistance line. This is the key. It shows that even though the price is still rising, the buying pressure is weakening. The bulls are running out of steam. I like to think of this as a mountain climber approaching a treacherous summit. They're still making upward progress, but each step takes more effort. They're exhausted, their breathing is labored, and the risk of a slip, a fall, grows with every foot they climb. The rising wedge is the market showing signs of altitude sickness. It's a warning that the upward climb is unsustainable. The analysis is a mirror image of the falling wedge. You identify the pattern by the two converging, upward-sloping trend lines, with the lower line being steeper. You wait for confirmation. In this case, the confirmation is a decisive break and close below the lower support trend line. This is the slip. This is the moment the market signals that the buyers have finally given up, that their final push has failed and gravity, in the form of selling pressure, is taking over. Again, a spike in volume on the breakdown adds a layer of confirmation. It indicates that sellers are entering the market with conviction. For a potential price target, the same classical method applies but in reverse. You measure the height of the wedge at its widest point and project that distance downward from the breakout point. This gives an idea of how far the price might fall. For managing risk, a stop-loss is often considered just above the last swing high made inside the wedge. If the price were to rally back above that point, the bearish thesis would likely be incorrect. Now, here's a crucial piece of nuance that separates novice traders from experienced ones. While wedges are most famously known as reversal patterns, they can also act as continuation patterns. It all depends on the context of the larger trend. For example, if a currency pair is in a massive long-term uptrend, and it forms a falling wedge, that's not necessarily a reversal of the whole trend. Instead, it's often interpreted as a complex pullback, a pause before the next major leg up. The breakout to the upside would signal a continuation of the primary uptrend. Conversely, if the market is in a powerful, long-term downtrend and it forms a rising wedge, that's often seen as a bear market rally, a temporary pause where buyers try to fight back before the dominant selling pressure resumes. The breakdown below the wedge would signal a continuation of the primary downtrend. So, the wedge is a story of exhaustion, but you have to know who is getting exhausted in the context of the larger war. Is it the primary army getting tired, signaling a reversal? Or is it a small counterinsurgency getting tired, signaling that the primary trend is about to resume its march? Understanding this context is what elevates these patterns from simple shapes on a screen to a profound narrative about market psychology. The wedge, in all its forms, is a masterclass in reading momentum, fatigue, and the explosive potential that builds when a one-sided battle finally reaches its breaking point. And that brings us to our number one pattern, the one that traders across decades have studied, revered, and used to identify some of the most significant market reversals in history. This isn't just a pattern. It's a complete three-act drama of a trend's life, peak, and eventual demise. We're talking about the head and shoulders. This pattern is the quintessential story of a market topping out. It paints a vivid picture of a battle where the bulls, after a long and glorious run, finally run out of steam and cede control to the bears. Let's break down the cast of characters in this play. First, you have the left shoulder. This is Act 1. The market is in a clear uptrend. Prices push to a new high, confidence is soaring. Then we see some profit taking. The price pulls back, creating a trough. This is normal, healthy market behavior. The bulls are just catching their breath. Then comes Act 2, the head. Fueled by renewed optimism, the bulls charge again, pushing the price even higher than the left shoulder. This is the moment of peak euphoria. It's the final powerful surge. But this peak is unsustainable. The buying pressure is exhausted. A much more significant sell-off occurs, bringing the price all the way back down, often near the level of the previous low. This is the first major warning sign. The strength of this rejection is critical. Finally, we have Act 3, the right shoulder. The remaining bulls attempt one more rally. They try to reclaim the glory of the previous high, but they fail. The rally is weak, anemic. It stalls out at a peak that is noticeably lower than the head. This failure is the ultimate confirmation of weakness. It tells you the buyers have lost their conviction. The energy is gone. Now, the most important part of this entire structure is the line that connects the lows of the left shoulder and the head. This is called the neckline. The neckline is the line in the sand. It's the support level that has been holding the trend together. All three acts, the confident rise, the exhaustive peak, and the failed rally, have been playing out above this line. The climax of the story is when the price breaks below that neckline. This is not just a technical event. It's a profound psychological shift. It's the moment the audience realizes the hero is not going to win. Traders who bought during the formation of the right shoulder are now underwater. The last bit of hope evaporates, and panic selling can often ensue, accelerating the downward move. A break of the neckline signals that the trend has, with a high degree of probability, reversed from bullish to bearish. And of course, this entire drama can play out in reverse at the bottom of a downtrend. This is called the inverse head and shoulders. It's the story of a market finding its footing and beginning a new ascent. You have a downtrend and the sellers push the price to a new low, forming the left shoulder. A small rally follows. Then, the sellers make one final desperate push, creating an even lower low. This is the head. This is the point of maximum pessimism. But from this deep low, a powerful rally erupts, showing that significant buying interest has entered the market. The rally takes the price back up to the resistance level, forming the neckline. Finally, the sellers try to push the price down again, but they can't even reach the previous low. They form a higher low, the right shoulder. This failure to make a new low is a massive sign that the selling pressure is exhausted. The bears are tired. When the price breaks above the neckline, it's the signal that the downtrend is likely over. It's the moment control officially shifts from the sellers to the buyers, potentially kicking off a brand new uptrend. Now, for a pro-level tip when analyzing this pattern, pay attention to volume. In a classic bearish head and shoulders top, you ideally want to see volume decreasing as the pattern forms. The volume on the left shoulder might be strong, but it should be lighter on the head, and even lighter on the right shoulder. This dwindling volume shows the fading enthusiasm of the bulls. Then, when the price breaks the neckline, you want to see a massive surge in volume. That surge is the confirmation. It's the sound of the floodgates opening. For a potential price objective, traders often use a measured move technique. You measure the vertical distance from the top of the head down to the neckline. Then, you project that same distance downward from the point where the price broke the neckline. This gives a logical, calculated area where the price might travel, providing a framework for managing the trade. It's not a crystal ball, but it's a data-driven approach based on the pattern's volatility. So there you have it. The flag, the double top and bottom, the triangle, the wedge, and the king of them all, the head and shoulders. As we wrap this up, I want you to take a step back. Forget the lines, the names, the specific rules for a moment, and think about what we've really been discussing. These 5 patterns are not magic spells that predict the future. They are a language. They are the market's way of telling a story about greed and fear, a story about momentum and exhaustion, a story of consolidation and expansion. A flag tells you a story of a brief pause in a powerful sprint. A double top tells you the story of a failed attempt to break new ground. A triangle tells you the story of a coiled spring, building energy for its next big move. And the head and shoulders tells the epic tale of a king losing his crown. Your job as a trader in the US Forex market or any market is not to just memorize these shapes. Your job is to learn to read the story, to understand the psychology behind why these patterns form. When you see a right shoulder forming on lower volume, you're not just seeing a chart, you're seeing the collective sigh of exhausted buyers. When you see a neckline break on a surge of volume, you're not just seeing a line being crossed, you're hearing the roar of the bears taking control. This is a crucial piece of the puzzle, but it is still just one piece. True trading proficiency comes from combining this pattern recognition with a solid understanding of the bigger picture. For Forex, that means knowing what the Federal Reserve is doing. It means understanding inflation reports, employment numbers, and geopolitical events. A perfect bullish pattern means very little if a major central bank unexpectedly hikes interest rates. Context is everything. Mastering these patterns takes screen time, practice, and a dedication to learning. Pull up your charts. Go back in time. Find these patterns playing out over and over again. See how they succeeded. More importantly, find the ones that failed and ask yourself why. Was the volume wrong? Was there a major news event? Was the broader trend against it? This is how you build true expertise. Not by looking for guaranteed outcomes, but by studying probabilities, understanding the narrative of the market, and always managing your risk. The journey to becoming a consistently successful trader is a marathon, not a sprint. These patterns are your map and your compass, but you are the one who has to walk the path. Keep learning, stay disciplined, and start seeing the stories that the charts are waiting to tell you.